Assalamu alaikum friends, welcome to day 5 of AFM revision crash course, the dividend decision. So what are we going to cover today? We are going to go through the past exam, then we are going to cover the clientele theory, we are going to cover the practical influences on dividend policy, dividend capacity, very important from your exams point of view, the two things. There are three things which is very important. One is the dividend policy, the other one is the dividend capacity, the other one is the transfer price. And then we are going to cover it in practice, dividend policy in practice. Share buyback schemes, because this can have an impact on your dividend capacity, dividend policy in multinationals, and finally transfer pricing. So let's start with the past exam history. If you see the past exam history, these two things is asked when a dividend question is asked. One is calculation of dividend capacity. You should be able to calculate. How do you calculate dividend capacity? Free cash flow to equity. Exactly, you calculate free cash flow to equity. Then we discussion of dividend policy. If you see, they are always asked together, calculation of dividend capacity as well as the discussion of dividend policy. If you see in June 2017, it came in the same question number 1, that means as a 50 marks question, and then question 3 and question 2. So this shows that this question can come in any question, either as question 1, 2 or 3, but they come together. Normally when you calculate dividend capacity, you have to discuss the dividend policy as well. So calculation and discussion both are very important for the dividend decision. Now let us go to the clientele theory. What does this theory says? This theory says what dividend signals to the market, right? If you reduce the dividend, it is not considered as something good. It's a bad news for the market. Then changes in the policy. If you change the policy, shareholders may have to sell their shares. And selling shares is not easy because it incurs some transaction cost. Then investors. Investors might choose a particular company for their tax planning reasons. Many investors have a preference for current income. What does it mean? That means they don't think about the long-term impact of the dividend policy. Neither they want to reinvest in the business. They want to get the dividend as quickly as possible because they want to have the dividend currently. They don't want to invest in the business, reinvest in the business. Clientele theory. This states that the firm should attempt to adopt a stable and a rising dividend payout ratio. It should be stable. It should not be something which is very dynamic and keeps changing, right? And rising dividend payout ratio. Why? To maintain the confidence in the company. When the dividend payout ratio is increasing, right? When your dividend payout is stable, that means more or less it is similar in every year. This maintains some confidence for the shareholders, for the investors, potential investors. It's easy for the prediction also. You can predict, okay, this is the dividend payout ratio. You can predict whether you want to invest in that company or not, looking at their dividend payout ratio. Now, let us go to the practical influences on the dividend policy. 1. We need to consider these few things before we decide on the dividend policy. Before we consider the dividend policy, we have to consider these things. Number 1, legal position. We have to see the legal position. The level of profitability. Because if you are profitable only, you can pay dividend. Otherwise, you cannot pay dividend. And loss-making company cannot pay dividend. Inflation. How much your dividend has to increase with in line with the increase in inflation. Growth. What is the growth in dividend? Control. How well are you controlling the dividend policy? Tax, liquidity, and other sources of finance. This you need to consider before deciding on an appropriate dividend policy. Now, this could have an impact on the dividend. This all the things that you have considered, this limits your dividend capacity. You just cannot decide on the dividend capacity as much as you want. There's a limit to that dividend capacity. All these things will bring the limitations to the dividend capacity, the list that is given on your left. So this will have impact on the dividend policy. All these things will have an impact on the dividend policy. Next, move on to the dividend capacity. Dividend capacity is the ability at any given amount of time to pay dividends to a shareholder. Okay, you should be in a position to pay dividend to your shareholders at any time. It could be any time. What is your capacity, dividend capacity? How much dividend can you pay to your shareholders now, if I ask you? Then, legally, the firm's dividend capacity is determined how? By the amount of a accumulated distributable profit, isn't it? Because from the profit only you can pay dividend. So whatever the accumulated distributable profit you have, from there only you can calculate the dividend capacity legally, okay? But from your exams point of view, more practically, dividend capacity is calculated using free cash flow to equity, FCFA. I have earlier uploaded a video on this, free cash flow to firm and free cash flow to equity. So if you're having an issue to calculate free cash flow to equity and not understanding, you can go and check that video out. Free cash flow to equity, you will get it under investment appraisal. My playlist, AFM -1 investment appraisal, you will get that free cash flow to equity. Okay. After reinvestment, because if you are retaining something, that will not go as a dividend capacity. After you have retained, after you have reinvested, whatever is remaining, that only will give as a dividend. So that is your dividend capacity. Okay. Note that it is free cash flow to equity, not free cash flow to firm, because free cash flow to firm goes both to the equity holders as well as debt holders. Okay, free cash flow to equity is only left after deducting your debts and everything. It will only go to the equity shareholders, and you pay dividend capacity. Dividend are paid to the equity shareholders after everything is paid off, your debt and all. Okay, next, dividend policy in practice. In practice, in real world, stable dividend policy. Okay, constant payout ratio. Dividend policy should be stable and the payout ratio should be constant. It's not that some year it's increasing, some year it is decreasing. It's not a good, these are the good practice, good dividend policy in practice. Having a stable dividend policy, having a constant payout ratio, zero dividend policy. Policy could be of different types. Another one could be a zero dividend policy. You might not pay dividend at all. Or residual approach. After everything is paid off, whatever is remaining, you are paying it as a dividend. Ratchet patterns. We are going to cover this in detail in few minutes. And scrip dividends. What is scrip dividends? Dividends in a form of new shares. Now, what does scrip dividend do? They allow the shareholders to increase their shareholding, but you don't have to pay any stamp duty or you don't have to incur any cost. Okay, without paying the broker's commission. And helps the company with the liquidity. Liquidity position is improved and tax paid is also reduced. You don't have to understand in detail about the scrip dividends and all. They will not ask you, but just understand what scrip dividend is and how does it increase your shareholding and all. That's what you need to know. That it helps in improving the company's liquidity position and increases the shareholding without paying tax and incurring cost. Now we are coming to the ratchet patterns. What is it? Many companies adopt this pattern. It is a variant of a stable dividend policy. Okay, it is a type of a stable dividend policy. Even MNCs adopt this. What is it exactly? It is you are paying out a stable but you are rising DPS. DPS means dividend per share. You are paying out a stable only, but the dividend per share is increasing. Okay. Dividends lag earnings. What does it mean? There's a lag. There is a time difference between the earning and the dividends. Dividends you are paying after earnings. Okay. There's a lag. Not you're not paying exactly on the same day as you get the earning. You will be paying it later. Dividends can be maintained when earnings fall. Avoid bad news signal, right? Because your DPS is increasing. So it avoids bad news signal. Even though dividend falls, it will not have an impact so much because your dividend per share is increasing. Avoids altering investors' tax position. Okay, it avoids changing the Investors' tax position. Tax will not have so much of impact here in the dividend policy. Then share buyback schemes. This will have impact on your dividend policy, dividend capacity. That's why we need to know what is share buyback schemes and how it can have an impact. Share buyback scheme means you are buying back the shares from the shareholders and you cancel them. That means your shares are reduced now because of this. So because you're, and remember, share buyback schemes you just cannot do according to your wish. It has to be allowed by the Articles of Association, and it's not happening normally, but it often occurs when the company has no positive net present value projects. Okay, it's not normal situation. It does not happen normally. It happens at certain situations. Then it can be cosmetic exercise to increase the share price. Cosmetic means something you are trying to hide something, right? What do we do when we do cosmetics and all? We try to hide our natural, for example, if someone is dark, you try to hide it, right? You put powders and everything. So this is also like that. You are trying to hide it inside the makeup, the natural, your natural, you want to hide it the way you are naturally. So same thing. Excess share price are not naturally they are not increasing. Artificially you are trying to increase it by doing the share buyback schemes. So it's a cosmetic exercise. Reduces the cost of capital by increasing gearing. It reduces the cost of capital. How? Because in the cost of capital we have a cost of equity also. Okay. And when your equity, your shares are reducing, that means you are having a lower cost of equity now with the cost of debt. So because of that, cost of capital will reduce. Gearing will increase because you'll be having more debt than equity, yes, but cost of capital will reduce. And it is an alternative, that means a substitute for a special one-off dividend, the share buyback schemes. Okay. Then there are some advantages and disadvantages of this that you need to know. What are the advantages? Number one, it is flexible. If excess cash flows are thought to be temporary, that means you are not going to have the excess cash flow. Then it's flexible, share buyback schemes. Then it increases your EPS, earnings per share. How? Earnings per share is earnings divided by shares. So if your shares are reduced, earnings will be divided by a smaller amount of share. That's why your number will increase, EPS. Adjust the equity base to a more suitable level. You can adjust it to a more suitable level, the equity, by reducing some of the shares. Buy out dissident shareholders. Yes. Then create a market for shares. You can create a market because you're buying back the shares. So there's a market for it. Reduction in the cost of capital. The biggest advantage is this. Out of all in the list, reduction in cost of capital, you should be able to identify this. One is increase in EPS, the other one is reduction in cost of capital. Then reduces the likelihood of a takeover for acquisition and merger. Right? This is one of the what do I say? One of the activity that is being taken by the manager to reduce the likelihood of a takeover. If they don't want to go for a takeover, if they object in the takeover, they are against it. They want to prevent the takeover from happening. This is one of the way managers do it. They prevent themselves by buying back the shares. Hence, they reduce the shares, which makes it unlikely to be attractive for a takeover. Okay. Give shareholders a choice. You can either hold or you can sell. Coming to the constraints, and also it saves transaction cost. Coming to the constraints, price paid may be too high. Yes. Approval of shareholders are needed. You just cannot adopt the scheme. You need the approval of the shareholders. Shareholder discontent. Some shareholders might not be happy with it. They might not approve of it. May reduce the future dividend capacity. Yes. In the future, dividend capacity might reduce. Can be seen as a failure. It's not that always it will be successful. This can be a failure. And shareholders may not be happy with this. Coming to the dividend policy in MNCs. MNCs also have to consider the same things that is generally considered for the local company regarding dividend policy. But here they have to consider some additional things. What are they? They need to consider the dividends between the group companies as well as to the external shareholders. Next, many of the external shareholders may be requiring stability in the dividend flows. They want stable dividend flows. The external shareholders I'm talking about, okay? External to the group. Then, when considering dividend capacity, you have to take care of this few certain things when it comes to MNCs. Remittance, very important. Even in your exam, you must have seen a question on this. Remittance and all. I remember one past paper question, I don't remember the year exactly. They asked something regarding this only to calculate dividend capacity, and they are blocking the remittance by some percentage, something like that. And then you have to calculate the dividend capacity under that condition. Something like that was asked. I don't exactly remember, but just make sure that if you go through past paper, if you see any question like that, then you have to refer to this slide again if you're not understanding it. Okay. So remittance blocking can limit the funds available to pay dividends to parent company shareholders. Remember, when a parent has a subsidiary overseas and that subsidiary cannot remit the fund back to the parent, so the dividend that parent company shareholders have to pay to their shareholders, it will be limited, it will reduce because they are not receiving that remittance from the subsidiary. If they would have received that remittance from the subsidiary, they could have paid more dividends to the parent company shareholders. But now the remittance is blocked. So under that condition, dividend capacity will reduce. Okay. Then liquidity. All of the following can impact on the free cash flow to equity. Intra-group dividends. If there's an intra-group dividends, free cash flow to equity will be affected. Transfer pricing. We are going to cover transfer pricing at the end of this video. Timing of central remittances. If the remittance timing is different. Reinvestment policy. If you change your reinvestment policy, for example, you made a decision you are going to reinvest everything that you earned. That means you will not be having any dividend. Hence, this will have an impact on the free cash flow to equity also. Tax regime, your tax. This also matters. Are you paying dividend in a region where taxes are high or low? This affects. And reorganization, when you are reorganizing. Next. There are some methods that are adopted to prevent or minimize the effect of this block remittances. Okay, that the parent company can do. What is it? Transfer pricing. They might put the transfer pricing in such a way that parent get the maximum amount of remittance in their country. The remittance, the fund is transferred to their country. Okay. Intra-group lending. They could lend to their subsidiary overseas. The parent could lend to their subsidiaries overseas. Royalty and patent payments. Parent might say, okay, I want a royalty of this much, a patent payment of this much from the subsidiary. Management fees and charge. They might charge a management fees. Parallel loans. Okay. You are taking a loan also in the subsidiary overseas. So that the effect of that block remittance is minimized. You are doing all those things. The host government may try and prevent many of this. Who is the host government? The MNCs, the overseas country, where they have remitted the block. The government which has remitted this, blocked this remittances. He is the host government. He is known as the host government. So the host government will try their level best to stop this from happening. Stop all these actions, all this 5 things that you are trying to do to minimize the effect. They will try to prevent this. Now, free cash flow to equity. How do you calculate free cash flow to equity? I have a video on it, but for summarization, this is the formula. Operating cash flow, you will be adding the dividend from joint venture. This dividend could be from subsidiaries also, okay? Joint venture subsidiaries and all. So dividend from that minus any interest that you have paid, minus tax, minus capital expenditure, okay? Plus and minus acquisition disposal. If it's an acquisition and it's a disposal, okay? You have to add and deduct. It depends whether it's an acquisition or disposal. If it's an acquisition, you deduct. If it's a disposal, you add. Sorry, if it's an acquisition, you add. If it's a disposal, you deduct. Add minus capital issued. I'm sorry, I told about disposal, right? Looking at that sign, no, no, no. It's a disposal that you have to add because when you dispose, you will be receiving cash. Acquisition, you have to deduct. New capital issued, you have to deduct. Then tax regime. When you are looking for the host country, which country to do business with, you will be looking at the tax regime, whether it's a higher tax or a lower tax, because tax regime can affect the attractiveness of the host country and the way also in which funds are repatriated. Because usually what happens when you are doing a business with a with a country where the taxes are high, you want that country to send back the remittance to you because you don't want to pay tax in that high country. So you want to pay that remittance as soon as possible back to your country. But the host country will try their level best not to do this. They want to block that remittance. Why? So that they can receive the high amount of tax in their country. Next, transfer pricing, very important. So what is transfer pricing? Transfer pricing is when you are charging a price for goods and services that you are supplying to the same, they are in the same business, okay, same organization, they're in the same group. For example, parent is sending to the subsidiary, subsidiary is sending to the subsidiary, the price that they are charging to each other. It is not external, it is an intra-group sales that is happening. When you are setting a price, that is known as transfer pricing. Next, what is a good transfer pricing system? What does it include? It includes maintain divisional autonomy. When you are setting the transfer pricing, it should be set in such a way that it maintains the divisional autonomy. Every decision has the right to decide a price. Maintains motivation for manager. It should be something that manages the motivation for both the department, not just one or both the groups. Assess the divisional performance objectively, not based on the transfer pricing. If, for example, one group is setting a high transfer price, the one who is selling will be gaining and the one who is paying is losing because he has to pay a higher price. So if you base your decision performance based on that, the one who is selling will be considered that he is performing good and the one who is purchasing will be considered that he is not performing so good because his cost is high. So that's not a good way. You have to assess the divisional performance objectively when it is relating to the transfer pricing because it's very easy to manipulate transfer pricing and easy to manipulate the performance. Then ensures goal congruence. Transfer pricing has to be set in such a way that both the organizations are trying to benefit the group as a whole. The department should not think, okay, I will try to maximize my profit. The other department will be thinking, I have to maximize my profit. Even if the group as a whole is not benefiting, no. It is simple to operate. It should be something which is simple to operate and understandable also. And it should be flexible. Coming to ethics. Transfer pricing can be linked to your ethical questions. Remember, you'll be getting one question on ethics, especially in question number 1 as a 50 marks question on ethics. So transfer pricing could be one part of it. It can come as an ethical issue because you have to set your transfer pricing. It is a social responsibility and you have to act as a responsible citizen when you are setting the transfer pricing. Because if you are not setting the transfer pricing and if this comes to the media, then it is going to affect your reputation and hence your business. Okay. Now, what are the multinational aspects? These are the things you have to consider when it is regarding the multinational aspect. Lower tax duties and tariffs. You might want to choose a host country where the taxes are low. Money repatriation, where remittances can be sent back to you from that country. Foreign exchange exposure. You have to see the stability of the currency, that currency you are dealing with. Competitive position of that country. And the host government relationship. How the relationship is with you and the host government. If it's good, you are going to get some favorable treatments. If it's not good, he is going to limit the remittance. He is going to block the remittance or something like that, which is going to cause trouble for you. So that's it for the dividend policy and dividend capacity. Tomorrow we are going to cover the WACC, a very interesting topic. How to calculate cost of equity, how to calculate cost of debt, and finally WACC. So see you tomorrow. Till then, take care.